See this? It is just 4 crores, huh? Why is it growing so rapidly, sir? What is happening? Small amounts, big. Yeah. So, smaller amounts of money when invested for larger periods of time can become bigger and bigger. And what also happens is, as you can see, incomes, I'm looking at some 10% increase in incomes, and you were finding that our man actually earns a income of 1.5 crore. You take somebody who is making 50,000 today and tell him that in 35 years you will be earning 1 crore. You think it's believable? So, strategic personal finance is about setting that goal. It's not about financial goals and funding for children's education. Let them loose. Let them fund their own education. Yeah? Let them work like how children elsewhere in the world work, right? They work keeping tables and serving food. So let the kids work. What managing personal finance is about having that target of the amount of money that you will have for yourself. Like a milestone. I'm going to be so, there are people who work out who say that this is the ideal body weight I will reach, right? So it is quite possible for a 30-year-old, 25-year-old to look at the first 1 crore, you're right? For a 30-year-old to look at the next 5 crores, for a 40-year-old to look at the next 15 crores. Yeah? So how many here whose personal wealth is 10 crore plus? You can meet me during the break. Right? The problem really is, that's what was the earlier slide. The problem is that we all think that if we need wealth of 15 crores, I'm only saying there's a market for earning, there's a market for giving. I'm a voracious giver, but I don't conduct free investor education classes. This is an exception. I made this exception for Professor Murari. Why? Yeah, don't be so guilty about the low profit class. Some of you are looking very sad. Yeah? I do completely free classes also. So don't worry about it. Yeah? As long as people learn, it is fine. There is a market that pays me by the hour as well, right? But that is a market which is asking where should I make the next investment, right? And the return on the investments for that market is much higher. I don't know what the return on your investment of time is going to be looking like, yeah? So if you're very concerned, oh my God, I'm not feeling very good about this, yeah? You can sense that. Don't worry about it, yeah? But give. My message was something else. It's not about paying for this class, but it was about give. Give beyond your children, yeah? Give. And make sure that your assets are invested strategically and not invested because you believe that money can lie there. Right? These assets, now what we have not shown here is about using of these assets. I've just showed you accumulation of assets. So primary objective in personal finance is what? Asset accumulation. You must have those assets. Assets make you feel rich, make you feel good, make you feel empowered. You can make those choices with tremendous amount of confidence, right? And the only way to build assets is by ensuring that there's a regular amount that is not saved. So it's not the traditional thing. Borrow as much as you can, save as much as you can, ensure that it is all invested, right? Then your assets are going to build up. And how those assets will get built up, what are the principles of asset allocation, and what can go wrong here? Because this is something you can maintain for yourself on a every year basis. It will not be the staid, simple thing, right? There will be times when your equity will give you better returns and your debt will give you lower returns. Those are things we'll discuss after we have had a couple. These assets must be higher. So typically, what does a common investor think? I'm borrowing at 11, the asset should return at 14. Is that right? Sadly, there are no such assets in the world. If you're looking at assets which are providing a steady return, they will remain at below 11. Huh? What is that 11% borrowing rate of the bank? Where does it come from? What determines the borrowing rate? The borrowing rate is nothing but a compensation for delaying the use of money. Is that right? Purchasing power. You have 100 rupees today, you can buy something today with it. I can buy this mic with it today, let's say. Now instead of buying this mic, I give you the 100 rupees. So you will use it, and sometime later you will return that 100 rupees back to me. When you return that money, I should be able to buy the same mic whenever you do it. Is that right? So you must remember that fungibility of money. Money is about moving things between today and tomorrow all the time. Correct? So when I take an interest, or when a bank charges an interest or pays an interest, what does the market or the debt market, what does the debt market do? The debt market provides an indication of what borrowers and lenders generally think is the compensation for inflation. So if the inflation rates are coming down, interest rates will come down. If inflation rates are going up or expected to go up, interest rates will move up. Is that right? So if the bank is borrowing at that compensation for inflation, can everybody borrow at that rate? No. Why not? Each one's personal balance sheet is different. Is that right? Credit risk. So each borrower will have his own credit risk based on how his balance sheet is structured. How much equity is there? How much assets are there? How much borrowings are there? What is the repaying capability? Is that right? So if the repaying capability is low, market is a nice place because in the market, money is available for everybody. Only the price changes. So if the balance sheet is bad, the person will still get money, but he will get money at a much higher rate. Is that right? So some amount of the compensation is for the credit risk and some amount of the compensation is for something else. Which is what? Everybody doesn't borrow for the same time period. Is that right? Somebody will borrow for 1 year, somebody will borrow for 2 years, somebody will borrow for 10 years. So what is the normal rule? 10-year rates will be higher than the 1-year rates. Why? Liquidity premium, I don't know, right? If you ask me what is the inflation next year, I can say, based on what Raghuram Rajan is saying, it looks like it will be 6%. If you ask me what will be the inflation rate 10 years from now, how will I know? Correct? 1985 was my first assignment on the markets. Okay? And by 1988, we submitted this report on introduction of money market instruments. There was no money market. No? Only call market was there, and call market was fixed rate of 10%. No treasury bill, no CP, no CD, nothing, no money market. Imagine. Yeah? So 1988. What do you think was the inflation 1988? Give me some number. 19%, sir. 19. What do you think was the bank prime lending rate? 22%. So if you told me at that time that inflation will be single digit, it will be incredible, right? So no one is seeing the future, you see. So today we think 6%, 7%. Who knows, 20 years from now, India may be in a place where inflation is only 3%. So bank will give you only 3.5%. Is that right? So therefore, the interest rate in the market, correct? Or the rate in the market, or the compensation in the market is lower than that level now, which you are thinking of, at which money is coming to you. Why are you getting money at level? First of all, you are borrowing for 20 years for the house. Second, you are borrowing on the basis of your personal balance sheet. No one knows whether your job is going to be there tomorrow or not. Correct? So the bank will say, I can give you money only at 11, which means what? The actual rate in the market is a good 3 to 4% lower than what the bank is giving you. Is that all right? That is the return that is available. So where will 14 come from? So you get the equation, right? You are borrowing at 11, market is at 7. What is the assumption we made? If we borrow such that the assets are returning higher than our borrowing rate, that itself is a wrong assumption first. Which is the asset that is returning more than the borrowing rate? You're with me? You all had a cup of tea, right? So you must be feeling more fresh. So tell me, where are those assets? So you are at 11. So you must remember that there is theory and there is the real world. Right? 11% is where you are borrowing, and what are you assuming? If I get 14, it is enough, huh? Then I can borrow. Correct? So who's giving 14? You tell me that. So the only assets that can give you 14 will be what? Somebody who's borrowing in the market at 11. You get it? And is creating a business or creating an asset in which he hopes he will make a return which is better. Is that right? So the 14 will not be a straight line ever. How will the 14 be? It will go up and down every other time. So any rate which is higher than the rates of inflation, any asset which is providing you a rate which is higher than that will mean what? It represents an entrepreneurial venture, or it represents an asset with risk. A risky asset is one which will provide you this premium. What is a risky asset? A risky asset is one which is borrowing money from the market at 7, 8, 9, 10, 11, whatever, okay? And putting it in something and hoping to earn a return which is better than that. Is that right? So when you are borrowing and investing in an asset, where are you investing actually? You are investing in the balance sheet of somebody else. So when you buy a property, what is the risk you are taking? Balance sheet of the builder. You are taking a risk on the balance sheet of the builder. So why do houses get delayed? The balance sheet of the builder is so underfunded that the moment he receives an advance from you, what does he do? He either pays the earlier debt or he starts a new property. He builds more assets. Is that right? That is why real estate is essentially risky. Is that right? Which is why real estate investing is as risky as equity investing. If choice of stocks is difficult in equity, choice of the property which will appreciate is risky in real estate. So you need to be very sure. What control do you have as a borrower on the builders, how you will utilize the money? It's a one-sided agreement, right? You give the house wherever it is ready. So therefore, borrowing to buy property, you should borrow, correct? But you should borrow provided you are able to understand the risk of the balance sheet to which you are giving the money. Is that right? Once you have done that, now you can, which is why most of our borrowing, routine borrowing, happens for what? Liquidity purposes. Hand loans, credit cards, correct? We have to know. How big is that market, borrowing for liquidity? You tell me how big is this market? Give me some number. Some number. 1 lakh crore every day, overnight. Yeah? 1 lakh crore is borrowed on an average by banks and institutions because they are short of liquidity. Somebody has drawn money, they need money to pay. Somebody else needs money. Is that right? So the market for liquidity is the largest lending market in the system, not just in India, all over the world. Correct? What happens in this market? People lend and borrow because, not because they have some funding requirement, but because they are short on that particular day. What happens in this market? What happens when you lend money to a friend? Typically you lose the money and the friend, right? Correct? That is the rule of this market. If you default, you can't access the market. You get it? Not only will you lose your money, but you will tell others also. He will come asking for money, don't give money, he never gives it back. So soon enough the reputation will spread. No one will be willing to give him any money. Is that right? He will be out of that market. So this market has the lowest credit risk. So if you have money, now for example, if you looked at your NR friends in the Middle East, how do you think, where do you think they are investing? They are sadly investing in real estate. That's a common problem. Yeah, nobody is free from that evil. But there is one more thing that they do. What do? They simply borrow from their local banks at 1 or 2% and they invest it in the Indian markets. Is that right? A large amount of money. How does that investment happen? How much is their money? How much is the bank's money? 20 rupees is their money. 80 rupees is the bank's money. Correct? So that's the second thing that you must remember, that leverage is not only a function of how risky that market is, it's also a function of what percentage of the asset do you cover. Is that right? So if you have a house, what percentage of the assets is covered by the borrowed funds? How much of it is your own funds? Is that right? So if you are able to, so Archimedes is supposed to have famously said, give me a liver, I will lift the world. Give me a place to keep the liver, right? I will lift the world. So leverage works like that, where it is possible for you to acquire 100 rupees of assets with 20 rupees of your own money, provided there is a lender who will give you 80 rupees. When will the lender give you 80 rupees? When he knows that this asset's value is not likely to fall dramatically. Is that alright? So therefore, when you use leverage, you can use leverage for funding. All businesses use leverage routinely for funding. Is that right? Suppose there's a panwala outside who's doing roaring business. Correct? And you suddenly find out that he was doing ordinary business. You suddenly find that his business has doubled. What do you think might have happened? Take a guess. Many principles in finance are very simple actually. Ordinary business, simple business he was doing. He was doing some 500-600 rupees a day. Suddenly after a month you are going there, you are finding that people are thronging his shop and he is doing 1,200 rupees. Nothing has changed. That's the power of leverage. The moment he gives credit, his audience will grow. Buy today, buy tomorrow. So number of people who will buy from him will increase. Is that right? That's the power of leverage. So what is it that he is doing? He is actually using his stocks, correct? To be able to raise money, right? And be able to sell those products at a margin. As long as he is making that margin, he can always take that money in. That's how your vegetable vendors work. They unfortunately pay very usurious rates, right? They borrow 100 rupees in the morning, pick up the vegetables, sell throughout the day, realize 104 rupees out of it, of which they pay 1 rupee. Imagine paying 1% per day. That's the interest they pay. Because they have no access to formal finance. No bank is willing to give them money against the collateral of vegetables. So if there was a product like that, you and I can easily buy. It's a very good leverage product with very good asset quality and great control on the entrepreneur. Is that right? But those markets are not available to us. We can only go to markets that are available to us. So not all leverage is bad. We routinely use leverage for liquidity. When we use liquidity for funding, we need to be sure that we are buffered for the possibility that the asset we have funded will go up and down. If it's cover fall, then we are stuck with a huge debt we are paying and the asset is not appreciating. So we need to make that selection very clearly when we look at building assets. Alright. Now, we have said this already. So these are decisions which we routinely take. Now there are people who build cash assets. There are professionals who take cash. My doctor friends are quite large there. Yeah? So there are professions in which you earn cash. So what do you think happens to the cash? It becomes black actually. It's an asset on which you have no control. So that's a call you have to take. Or it becomes discretionary expense. It is just spent on holidays and clothes and jewelry and other things. Right? So it's important for you to see if you want to build assets, it might be better for you to pay taxes and do it. And we will talk about all of these decisions we will be taking with our money all the time. And as I said, we should be able to take that decision consciously. Now to your asset allocation. Yeah, the second part of what I have to talk to you about. Taking your money to the markets. I've already told you about some of this. Yeah. So how should you invest? What is the asset allocation? How should you invest? So you have some spare money, correct? So what do you do with it? You keep it as cash. Zero return. Worst asset allocation. What else can you do with it? Keep it in the bank. Banks have managed to do that, right? Why do we keep it in the bank? Secure, okay? So that's the marketing. Marketing that banks have successfully done over years. Created large structures with big lockers and told us that we are keeping your money safely. What is the reality? They are borrowing from you. They are biggest borrowers. In the whole world, banks are the biggest borrowers who live on the mass understanding that money with the bank is very safe. Yeah? So, and of course there is regulation that makes it difficult for banks to default, because what happens is money in the system, as I told you, liquidity is a big market. Money keeps moving around. Imagine a set of pipes through which water is flowing. Yeah? That's how the liquid markets are. Right? When we say liquid market, what does it mean? Somebody is paying you a salary. His account is debited, your account is credited. You have paid something. Correct? Then your account has to be debited, that guy's account has to be debited. This transaction happens between banks, as I told you, 1 lakh crores. Correct? Is the borrowing. The amount of transaction is a multiple. Correct? So a good amount of money keeps moving in the system on a everyday basis. Is that right? So how do we manage this? How do we manage this? electronic, all the technological advancements are to reduce the speed of movement of money from one place to another and for ensuring that these are well controlled. But if, despite the best effort, a bank can fall short. Now let's assume that SBI is paying off